Hey, another week in CFA stuff. Let's review our timelines and then we'll go right into last week's questions because there's quite a few really good content questions, so we can spend some time there. May 24, if your exam is coming up for May 2024, level 1, 57 days to go, less your review period, which is important. Don't blow that off. You got 29 days. You should be 85, at least 85% of the way through, pushing up to 90. For level 2, you have a little bit longer, 64 days, less your review period, 36 days. You should be north of 80% done, pushing up to 85%. If you have the August exam, level 1, 18 weeks to go, 126 days. I am, of course, in all of these, I always include the review. So the time I give you is not including the review. You got 18 weeks to get the content done, and then you have 4 weeks for review. For level 2, 19 weeks. Level 3, short change this year. Usually level 3 comes after level 2, but this year it's coming before level 1 even starts. 16 and a half more weeks. I say 5 to 10% done. I think you should be somewhere between 10 and 15% at this point, especially for level 3. You should be well on your way at level 3, maybe you have up to 20% done. For November, lots of time here, but that doesn't mean you should just ignore the calendar and wait until you have less time. 211 days for level 1. That's lots of time. I don't even have a percentage done because if you're not going to start for another month, I think you're okay. Once we start getting down more towards 180, 170 days, then yeah, at that point I'd say, look, you've got to make a decision to start soon. 211 days at level 1, 218 days at level 2, and again, once you complete that, you still have 28 days of review. For August 2024, your registration closes May 14th. You got 56 days before registration closes. The early registration is done. For November, early registration, April 16th, you have 29 days to get the lower price. So if this is something you're going to do for November, no point waiting till the very last day. You just might forget. If you're going to do November, you can get the lower price now. Why not get it out of the way? Another week over, another week closer to exam results. Level 1, you have 17 more days. I know it's nail biting, but you got to wait it out. 17 more days. If you get a pass, level 2, you're making a run for August or November. I would seem to think November gives you more time, plus you get a lower price. You'll have your results out for level 1 before early registration for level 2 or for November is over, so that's good. If not, if you didn't make it, I see no reason why you wouldn't do level 1 again in August. You're not starting from 0. You don't need the extra time. Level 3, 24 days. And then hopefully you're done. Hopefully you go on and enjoy the rest of your life. For your exam results, level 1, remember your practical skills module must be in by April 1st. You have 13 days to do it. These are time consuming. You really don't want to have to sit for 15 to 20 hours straight to get this done, right? You don't want to do that. You don't want to give up a whole weekend. 2 to 2.5 hours a day every day from here to the end of the month. Well, not even to the end of the month, for probably the next week, and you can knock it out of the way. You got to get it out of the way. If it's not done, you don't get results. This is the only thing standing between you and results. So how do you fill those 17 days? Get your PSM done. If you are done all that and you're just biting your nails, wondering what am I going to do for the next 24 days, especially at level 3, try jelly beans. So I'm sure some of you are wondering, what the hell do you mean try jelly beans? On our website, and even if you don't have any of the level 1, 2, or 3 subscriptions, if you register for free, you'll have access to jelly beans. Click on jelly beans, click over on documentaries, and we have curated from YouTube as many finance documentaries as we can find that are pretty good. So there's a whole bunch down here. Which one? Some friends of mine watched one the other night. Rogue Trader. Watched Rogue Trader, which is pretty good. But you can see there is a whole bunch of documentaries related particularly to finance that we have curated on our site. So you can kill some time there. Okay, Q&A. I'll go quickly over the non-CFA content questions here. Please do not get rid of the comment section. Probably asked 6 to 8 in total over level 1 and 2, but I've probably reviewed 75 to 100 of other people's questions. That was the original intent. I used to answer them privately through email, and I wasn't long before I said, look, I'm answering the same question 50 times. Let's just put a comment section in and be done with it. I can answer each question once, it'll be easier. But once you get to 10,000, 15,000, 20,000 subscribers, the number of questions increase exponentially, and it just became unmanageable. My understanding is that the CFA team is looking at bringing the comment section back in some form that makes more sense. I don't know what that is. Thinking of getting subscription for the QBank and reviews. Would you mind giving me a bit of information on the amount of questions and how they look on the website? I can give you a view of the QBank here. Just ignore the FRM parts here. 2024, level 1, 3,500, level 2, 2,163, and level 3, 1,455. You just can expand this, and it tells you how many questions there are in each of the sections, so I'll let your eyes run over that. I'm not sure if you were looking at level 1 or level 2. There's the number of questions in level 2, and for level 3, that's how it breaks down. So hopefully that helped a bit. Review videos. I don't know, since we've gone to the modules, or CFI has gone to the modules, the reviews don't make a lot of sense because each module has far fewer words. Even if you take all the modules that make up a section, the number of words have decreased significantly. So what used to take 1,000 words is now being done in 250. It is a significant reduction in the amount of words around the amount of narration. I don't know how you shrink that even more. The number of walkthrough examples have increased on the other hand. So the amount of content is the same, pages of content to get through, but rather than it being like a 20% examples, 80% narration is now almost flipped to the point where it's maybe 30% narration and 70% examples. Being that it's condensed so much already, how much more do you condense it to get to a review video, right? So I don't know that all the readings would have review videos. Standard of professional conduct, material, non-public information. Standard defines non-public info as non-public until it has been made available to the public. Where corporations often selectively disclose non-public information periodically, either to a small group of investors and or analysts covering that sector. Well, let's distinguish between non-public and material non-public, right? In just talking with your friends who work for different publicly traded companies, you're going to get some information about their job or what they're doing or what they're seeing that's non-public. It just may not be material. You're not talking to the CFO and he's saying, man, earnings just killed it this year. Whoops, sorry, don't repeat that. Well, don't repeat that. Are you kidding me? What did you just say? It further emphasized it's okay to get it, but not to act on it. This one is very tricky and I don't agree to that. Why does an organization even share such information with an analyst community in the first place? Well, it's hard not to talk about certain things. So when you have an analyst day, you're talking about some things. You're talking about perhaps the level of increased productivity you have because you have this new line that you've put in place. Well, maybe that's not written anywhere in your 10K or your 10Qs and you haven't said it anywhere. But you've mentioned that investment in CapEx will be targeting efficiency gains, right? So you sort of have, even though you haven't said that one thing, and analysts are fairly careful. If something in those particular meetings whoever from the company is presenting feels that, oh, you know what, I think I said a little bit too much there, they can always take steps to remedy that. There's no need to share and then expect not to act on it. Well, that's what ethics are about. Ethics is what you do when no one's watching. When you say that kind of statement, that tells me something about you, that if you had gotten information, it is unreasonable to not expect you to act on it. You know, I don't know that's a question as so much as a revelation. I can understand the need to share these details with an investor, but why an analyst who writes, modifies an industry report, and then changes the recommendation to buy wholesale that particular company? That's what makes an efficient market, is information. The investor may not have the time to go visit management and ask them a bunch of questions. That's what the analyst does. The standard is not self-contradicting. It's the key word you're leaving out is material, right? The standard is material, non-public information. But then in the next sentence, you drop the word material and then you just refer to non-public information. There's a big difference. It must be material non-public information. What happens after 5-year contract is up with Serify? Since you are doing the applied series under Serify, what happens when you go off on your own? I'm not doing the applied series under Serify, so here's the 5 years. I'm at 2 years. There's 5. I got 3 left to go. The applied level belongs to me, but it has to be somewhere. So it is sitting on the same site where CFA is listed, and it's also combined in with the CFA Plus package. So you can buy it at one time. All the applied level subscribers are mine. So after the 5 years are up, it's the 5 years of contributing CFA content. I can easily renew for another 5 years. I can keep going for as long as I want. I don't have to go anywhere. But that doesn't mean the applied level is done. Even after 5 years, if I say, you know what, CFA is boring the hell out of me, I don't want to do that anymore, I still do the applied level. That doesn't go away at all. From where I sit at this point in time, 3 years from now, who knows what I'll be doing in 3 years or how I'll feel. But if I had to make a decision today, I'm not going anywhere. I'm not going anywhere in this industry. I'll be here for the next 20 years. I'm not going anywhere. I have no plans to leave this industry at all. You have to take me out with a bullet. If you're my competition listening, you got to take me out with a bullet if you want me to go somewhere. But in 3 years, maybe I'll have a different opinion. Maybe something will change in my life and I'll say, you know what, I just can't do this anymore. But I'd still continue on with the applied level. I love that. Explain the difference in arriving at a forward versus trailing PE for the Gordon growth model. I'm having a hard time understanding the logic behind the difference in these two formulas. Timeline, here you are. So trailing is the last 4 quarters. This is historical. Historical meaning, another word of saying it is empirical. Empirical because it's happened. You don't need an estimate. You just need a calculator that has a working plus sign. Enter in the first set of earnings plus the second set plus the third plus the fourth. There's your last 4 quarters. You're trailing, what's called trailing 4 quarters. Sometimes it's written as trailing 12 months. That's not quite true because you may not have monthly earnings. You only have quarterly earnings. So the TTM really means the last 4 quarters that you have results for. Forward is the estimate going forward. This is an estimate. It is not empirical. It is either model driven or your best guess as to what the future will be. So one of them is fact. There's no arguing with the fact of what earnings are. Now you can take the earnings and you can say, well, I want to adjust it for one-time events or extraordinary items, etc. You can do whatever you want, but you can't argue the numbers. They're history, they're fact. Forward estimates are just your best guess and everybody's best guess, right? So if you are looking for comparison and you're comparing forward earnings and you're comparing the forward earnings on 2 companies that have a different set of analysts, let's say, well, maybe they're not comparable in that sense, because there might be different different biases in each group, because they are just everybody's best guess. If you compare those two on the last 4 quarters, you could say it's nobody's guess. This is exactly what happened. But what if these two companies had different growth rates? What if one company is expected to grow like this and another company is expected to grow like this, and here we are, right? This one will look like the better company because it will have higher earnings and a lower trailing PE. This one will look expensive, but look at the growth rate. On a forward basis, this one would be the cheaper one, this one be the more expensive one. If, for example, they were trading at the same multiple. So, since as investors we buy the future, it seems to make more sense to value the future, hence use a future multiple. Confirm the number of temps permitted by CFAI. I think is as of 2020. I think it's as of 2020. 6 per level. 6 per level. If you're on your 6th attempt at level 1, stop. We got to talk before you do it. Something's not working for you. Something is just not working for you. By the time you get to your 3rd do not pass, you should be sitting down for a counseling session with somebody and trying to figure out what the hell is wrong, why it's not working, or why do you want to keep doing this? Maybe you don't enjoy it, and that's why you're not very good at it. And if you don't enjoy it, why do you continue to do this? If you enjoy it, if you love it, if this is the industry you want to be in, but you can't get past this, there's something wrong that you're doing. So I'd say, the alarm bell should be ringing at 3, but don't go into your 6th one without at least having a good debriefing session about what the hell is wrong. Planning to take level 3 after taking a break for a long time. Is it possible for me to do the PSM for level 1 and 2 and if I'm not taking those exams? I don't think so. I think CFAI doesn't allow access to them, but I think they might if you're no longer just a candidate but a charter holder. I think. I'm not 100% sure there. I'm sitting for the August level 1 exam, fitting in regular review. What is a good target date to aim for in finishing the initial run through the material? 28 days before your exam date. Those last 4 weeks should be reviewed. 28 days before your exam date. Explain the key difference between F-test and ANOVA test. Well, ANOVA test. I think you're getting confused there. The F-test is part of ANOVA. It's not ANOVA test. We use F statistic for ANOVA test. Okay, I see where you're going here. Okay, so ANOVA is short. AN is analysis. The O is of, and VA is variance. It just means analysis of variance. And remember, when we're testing variances, we use a chi-square statistic to test a variance. So if we're testing the significance of a single variance, we use a chi-square statistic. If we're testing the significance of 2 chi-square variables, let's say it's a ratio of 2 chi-square variables, that's an F-test. So where would we use this? If you're looking at analysis of variance, you have your regression, you'll have your residual and your total, and you'll have your sum of squares. Sum of squares for the residual, for regression, sum of squares for the residual, and sum of squares for total. And then you divide that by whatever degrees of freedom there are for each one, and you'll get your mean MSR and your mean square of the regression, mean squared error. And there is your ratio. This is a chi-square distributed variable. This is a chi-square distributed variable. The ratio of these two is your F-test. It's not an ANOVA test. An ANOVA is simply, when we say ANOVA, we simply mean analysis of variance. And we test the significance of a regression in an ANOVA table with an F-test. Subscriber, level 3 August, started studying this week from volume 3, yield curve strategies. Had a hard time. Go back to the middle of volume 2, overview of fixed income. Okay, I see what's going on there. So when we say on our site volume 1 through volume 6, you have to click on volume 3 to see what readings are in it. It's not the same as volume 3 for CFAI. Volume 3 on our site is all of fixed income and all of equity. So that's why I say start with volume 3, the section on our site, volume 3. Yeah, in the CFAI books, you have fixed income in the latter part of volume 2 and fixed income in the first part of volume 3. For us, when we sell sections, it doesn't make sense to sell you volume 2 the way CFAI does it, because you get half a fixed income in there. It doesn't make any sense. You'll get derivatives, you'll get currency management, half a fixed income. So somebody would cry foul at that point. So, well, this isn't fair. You're forcing us to buy another section from you when all I wanted was fixed income, and you spread it out over 2 sections. You're ripping me off. So we made the decision to use our own volumes and say, well, listen, let's make sure we put every topic within its own contained volume so that we don't force you into buying 2 sections just to get one topic. So yeah, they could be a little bit clearer on our site that our volumes don't match up with CFAI's volume. I think both L1 PSMs, I did both, and actually found them pretty useful and indeed practical. Great that CFA is providing this. I coded VBA and wanted to start Python, but haven't had motivation to find free course, and this one was good for beginning. Modeling course great. I liked that it gives hints how to make stuff in Excel look nice. Question, do you think actually reading the readings on L2 is more important than L1? I did L1 just on your videos, but have finance master's background. I imagine L2 is more conceptually challenging. It's not more conceptually challenging, it's more quantitatively challenging, not conceptually. As you've been mentioning in other videos, there is more of a lean in the exams to ask more conceptual questions as opposed to quantitative questions, but level 2 is evaluation level, so it's quantitative work and formulas all over the place. If you don't read math well, and some people just don't read math well, you give them a math book, it's like, this is not a reading book, right? If you don't read math well, then yeah, a lot of the readings will hurt, especially derivatives. Derivatives, as the writer has written them, and I've said this for years, is basically unreadable. Don't even waste your time. I can't even understand what the hell the author's trying to do. The author is very skilled at taking something that otherwise was quite simple and making it massively complex. And I think it was for his own ego to say, look how smart I am. Look at all the notation I've used. I've used every letter in the alphabet. That's not the mark of genius. The mark of genius is take something complex and make it look so simple that you wonder why you never understood it to begin with, because it's just so straightforward. Derivatives is nothing more than time value of money. It's so straightforward. If you understand time value of money, you could create the formulas yourself just by moving money around a timeline. So for some of the readings, I'd say, yeah, I think a careful reading would make sense. For other ones, especially if you don't read math very well, it's probably not going to help you. Okay, I have a question with regard to risk neutral probability formula. P star equals RF minus R down over R up, R down. Okay, well, what you're referring to is, it's not RF, it's 1 plus R minus D over U minus D. So there is the whole range, up minus down, and you're looking at, this is up, this is down. Right, this is the probability of an up move. Let's say it's 1.2 and down is 0.8, and our risk-free rate is 5%. You would have 1.05 minus 0.8 over 1.2 minus 0.8. 1.2 to 0.8 is the whole range. 1.05 minus 0.8, risk-neutral probability. What are we doing here? Well, this is the risk-free rate. So what we're going to do is we're first going to assume what is going to happen considering a risk-free rate. Money should earn the risk-free rate. If we remove risk, we should get the risk-free rate. So when we price out options, the higher the interest rate, the higher the forward price is going to be. Options are centered around the forward price. So let's just draw a price chart and say, okay, well, let's go out 1 year and price out that option. Wherever it is right here, we don't just say, well, that's the at the money price. If the interest rate is 5%, we find the forward price. Options are centered around the forward price, right? So that is where we get the notion of a risk neutral probability. Because every stock will have its own level of risk. How are we going to get options done if we have to do it on every single stock? Isn't there a way that we can do it later in the process, where we can add volatility later on in the process? And that's what we're trying to do early in the process, is not add any risk, just figure out the risk neutral probability. So we'd have to get to, whatever the forward price is. The higher the interest rate, the higher the forward price, the higher the 50 delta call and put are, 50 delta being the middle of the distribution. The higher the price is versus where we are today, the higher the interest rate. So when we say that what we're calculating here, what we're saying is, in the absence of any risk, money would grow this way. Money would simply grow that way. So if we're thinking about a range, that it could be here or it could be here, if we're thinking about this range, we've already traveled that much of the distance. So if we think of the probability, P, as the probability of being in a certain part of the distribution, we have already traveled that much of the distance given the risk-free rate. That's basically what we're doing, is it's this distance over that distance. Okay, I think we're good. I'll just read the rest just in case it deviates here. Even though I know how to use it intuitively, it feels it should be measuring the probability of a down move if it comes from a uniform distribution. No, because it's measuring the distance we've already traveled. Yeah, okay, so I think I've cleared that up. Content question. Can you explain the logic behind the following formula? OAS equals Z spread minus call. Well, so the OAS, if let's try to think about it this way, a Z spread, I want to write it out so that you'll understand what I'm doing here. Let's just do this. OAS is Z spread plus option. That's the easiest way to remember it. If you have a callable bond, you are long the bond and you are short the call, right? Z spread minus call. If you have a puttable bond, you're long the bond and you're long the put. This is the easiest way to remember it. OAS is the Z spread plus the option. Whatever basis point, whatever amount of basis points the option is adding, but you are short the call in the callable bond, hence minus. How can the OAS on a risky bond be less than the constant spread? Think about the price yield curve, and I'm going to exaggerate it here. And let's think about price. Let's say interest rates are here and we're going to lower the price, lower yields. Well, look where the price goes on a straight bond. And if we raise prices or raise yields, there is the price that happens on a straight bond. Let's just put a callable bond. Remember, callable bonds are callable. So the call price might be 101, for example. So as interest rates go up, the callable bond would approach the straight bond because the call would have very little value. I'm going to try to draw it as best I can here, but as interest rates are dropping, notice how it's starting to diverge from the straight bond curve because the call is adding value, and as it goes up here, it's going to start to do this. It's going to start to be drawn towards the call price. This is what's called negative convexity. Right? It has negative convexity. So if we're trying to figure out what the credit spread would be on this one, because the price is not reflecting the true value of what the underlying bond is. The call is taking away some of the price. The call is squeezing out some of the credit spread that you would normally get paid for. The call is squeezing it out. So you have you're getting paid very little for the credit risk you're taking on, only because the call is squeezing out a lot of the spread. That's how you can get the OAS less than the Z spread. And you said getting 80% plus is generally fine on questions. At level 2, with only 80 graded questions, there's still that 20% of content that if it comes up, you don't know any of it. What 88 questions, 88, 4 times 11 times 2, 11 vignettes at 4 questions each. 2 exams, 88 questions. What are your opinions of this thought process? Well, if you get 80% of the 88 right, you get 80%. I'm not sure how you're slicing this up. After finishing your QBank for level 2, I'm on a 73%, so that's what I was thinking. I guess I'm not following your question, because if you're still getting 80% right, even if there were only 5 questions and you're getting 80% right, you're still getting 80% on the exam. I guess I'm not following. I don't know what the lower level of questions have to do with it, unless you're saying that with a smaller number of questions, there might be a greater than 20% probability that you're asked questions about the 20% you don't know. That's interesting. It's possible. It could be. Yeah, it's possible. Which is why when you get a score, you get, let's say that's the passing score and this is your score, you'll get a box like this that says based on some confidence interval, because of the randomness of the questions, based on a confidence interval, you would have passed. That had you taken the exam and you got a randomly different set of questions, there's a probability that you would pass, that your score is within a confidence interval of passing. And that does account for the randomness of the questions, but you are right, with fewer questions, there could be a greater than 20% probability that you're asked questions about the 20% you don't know. So with more and more questions, the probability of being asked questions about what you don't know approaches what you don't know, 20%, let's say. That's an interesting question. Continuing my struggle with ethics, questions on fair dealing. I'm reasonably confident that none of the private banking clients or investment management clients will appreciate of the services they receive based on their portfolio sizes compared with the retail bank or wealth management client. Reading also mentions that the levels of service should start from the best service, which will be made available to all, and then move upwards based on higher fees. Well, I'm sure you two disagree to this what happens in reality. No, I don't know why I would disagree with that. Biggest challenge I'm encountering with ethics is constantly contradicting practices happening in the real world. Wow. Okay, so I can give you a legal textbook. Page 1, murder, illegal. Oh, but I still see murder. How do we square that? Here's a law book that says you cannot kill someone, yet I see people being killed all the time. You can't control human behavior. It will be what it will be. Now, these are ethics, not laws. So when you say, I see people violating this all the time, 2 things. Number 1, not everyone's a charter holder. So not everyone is bound by the code of ethics. This is just a code of ethics. That's it. If you're in a bank and the person beside you is not a charter holder and they're doing something, and you say, that's against the rules, he'd say, well, what rules are you talking about? And you say, well, look, here's the CFA. He'll say, I'm not a charter holder. I'm not bound by those ethics. Go ahead and report me to the CFAI. They can't do anything to me. Which is why, we want organizations to adopt the CFAI Code of Ethics so that it doesn't just cover charter holders, it covers everybody. But you are bound by the CFAI's Code of Ethics. Even if your organization doesn't adopt it, you as a charter holder are bound by it. And I have said this before, that it may, in some situations, put you at a disadvantage. Because if everyone else is willing to cross ethical lines, but you're not, you'll underperform. That the world is not ethical? No. I'm clutching my pearls right now in shock. No. Come on. Yeah, that's the reality of it. The world is what it is. It's not fair. It's not ethical. It's not always legal. And in some countries, it's downright corrupt. But all we can do is be the best version of ourselves that we can be. And this is how we change the world. We don't demand that everybody change. We display a type of behavior and we act in a certain way that infects other people, that makes them want to emulate us. And we worry about that. And that's it. Be true to yourself. Don't worry what the world is doing. You can make the same argument with murder. Well, people are murdering. I may as well get in on that because I got a list. Let me tell you, I got a list. Taking level 2 in August instead of November gives a 6-month window to go for level 3 in February 2025. This is true. Is there a good rule of thumb for choosing August instead of November? The rule of thumb is if you're willing to sacrifice your time all the way up to level 2, and after you write level 2, don't wait for your results. Immediately start preparing for level 3. Sure, you could probably get that done. But you are taking on a burden. Just as long as you recognize that, is that you're not just going to walk a mile, you're going to throw 60 pounds on your back and walk a mile. As long as you're prepared to do that and not complain halfway through, well, there you go. You can do that, sure. Could you please confirm if there's a maximum number of attempts for the CFA exams? Already did that. Also, would you recommend the following courses: CFAI, Data Science for Investment Professionals? I haven't had a good enough look at it, nor the fee for it. I think I looked at it once and I thought, well, this is, if you picked up a course in university on regression, from single regression to multiple regression to time series analysis to some econometrics, well, that's it right there, right? That's a big part of it. When I looked at it, I thought, well, this is a big part of it is just quite a bit of repeat from level 1 and level 2 quant. It goes a little further than that. I don't know if I'd recommend it. I don't know enough about it to know if I'd recommend it or not. I would say this: give the course description and everything to your employer, and ask your employer if it has any value for them at all, and that will at least give you an idea of how to price it. How important is the timing between levels, specifically starting level 2 after passing level 1? Well, if you're going to try to make the second to next exam window, then yeah, you do have to do that. If I pass February 2024 L1, I will need a break to catch up on personal things and prevent burnout. Oh, well, then take November. Yep. However, I don't want to wait too long and make L2 more difficult by having to play catch up from losing some knowledge during the break. You're not going to lose knowledge during the break. Don't worry about that. Some things from level 1 don't carry over to level 2. Some things do. I'd say maybe there's 8 or 9 good readings in level 1 that carry over into level 2. But as you're going through level 2, a lot of stuff will just come back to you. You'll remember it. You're not going to lose that much. Don't worry about it. Giving level 1 in May, left with 3 subjects. Hopefully complete my syllabus by the end of this month, but do not know how to keep the approach after that. I'm also simultaneously doing the CFA website questions, and I'm getting a score around 66. My approach, once I'm done with the syllabus, and once I go for mock exams and what source, your level 1 May. Well, and this answer I've given many, many times as well. This is not your first exam. You have how many university final exams behind you? And when you do finals, it's not just one 3-hour exam. You have 3 to 5 3-hour exams in a span of 10 days or 2 weeks. And you finish studying for one, you head home, you study for the next. You go home, you study for, you got 15 hours of exams over 2 weeks. This is 4.5 hours of exams. Really, that's all it is. The the material is probably equivalent to a semester, a 5-course semester. So you're preparing for a final exam on a 5-course semester, or for a 4.5-hour exam, not 15 hours of exams. You've done this before. In fact, you've done more than this before. Think about going into the final exam and you think, well, how do I approach this? Whatever you did that worked for you then is the same thing you do now. It is no different. The only difference is you didn't have a professor in a classroom that you showed up to every week for 12 weeks. That's the only difference. But beyond that, the preparation, the process of learning that you go through is the same thing. It's exactly the same thing. So think about all those courses where you pulled out an A, and think about how did you prepare for that final exam. Do that. Do that. That's exactly what you do. This is no different than that. So you already know the answer to this. How does a market maker proprietary trading firm make money? On the spread, especially the ones who are active on multiple exchanges across the globe, trading options, futures, equities, FX, fixed income, commodity. Well, everybody, it's not one person that's all over the place. A firm will have different desks, a Forex desk, a futures desk, equities desk. When I say desk, it's not a desk you walk up to, but a group of 8 or 9 people in a corner of the floor somewhere where you walk over to and you say, well, that's the equities guys over there. I shouldn't say guys. That's the equities group over there. It's just called the desk, the equities desk, right? And that's what they do. You have one firm that may specialize in a whole bunch of different things. One of the prop trading firms says this market needs liquidity to function effectively. We trade our own capital at our own risk to provide just that. Where does the market maker get capital from? Their own equity, their own money, investors' money. You can help provide some insights. So prop trading firms don't always make money. I mean, they can lose money. They don't have any magic formula in making money. They have a process. They have a process that over many, many transactions, based on putting the odds in their favor, they make money. So if they're engaged in any market making activity, they're taking both sides. They're both buying and selling, and it's the spread that they're hoping to make money on. Now, when you think, well, yeah, but how do you, like, what if you're buying and the price is dropping, and then you're selling, or selling and then buying, however you do it. If the spread's moving, how do you make the spread? Is because when they do what they do, they hedge out very quickly, almost instantly. That they're trading equal or board lots. So if you put in an order for 53 shares on a stock, sometimes you'll notice that it just gets ignored. Unless they could do board lots 100 at a time, because they can hedge out with options very quickly, and then this way here they make the spread. They're looking just to make the spread between the two. The more competitive and the more liquid that stock is, or whatever it is they're in, the tighter the spread happens to be. But that's how you provide liquidity, is by being able to buy when nobody else is, and sell when nobody else is. And if nobody is doing it, the spreads are going to be very wide. And the spread will be wide enough that it'll convince somebody to start providing liquidity. Market makers, they attempt, if they know what they're doing, they should be able to make money every day, but they're not making money on the cards. They're making money on the players, right? They're the casino. They're making money on the players. They're not actually sitting at the table making bets on the underlying stock or the underlying option. Yeah, and that's it.